it is a matter of truth that the 1st February 24 budget that will be announced will just be a vote on account. By 2047, India should reach a $30 trillion economy size. For the growing population, growing youth, young who need more skills, who need to upgrade their skills, you need the newer areas also to get priority.
Good morning and welcome. This is NDTV Profit. My name is Alex Mathew and you're watching All You Need to Know. Today is the 1st of February and you know what that means. It's budget day. It's when the government lays down the roadmap for the year ahead. There are implications for companies, for the markets, and most importantly for you, the investor and taxpayer. Stay with NDTV Profit for the sharpest coverage of Union budget. But first, let's start with the headlines this morning. The Fed keeps policy rates unchanged for a 4th time in a row, rules out rate cuts in March. Markets hope of a rate cut shift to June. The US equities fall and the bond yields fall below 4%. The RBI cracks down on Paytm once again, imposes stringent curbs, stops just short of cancelling its payment bank license. As India prepares for the next 25 years, S. Jaishankar says it will compete and take an independent stance on the world stage. That's based on an exclusive interview. GST collections in January continue to be robust. The government records the second highest monthly collections at 1.72 lakh crore rupees. Now, before we start setting you up for the budget, let's take a look at the big news overnight. And the US Federal Reserve kept its policy rate unchanged for a 4th time in a row and also signaled cuts this year, but it indicated that it is not in a rush to cut rates. The FOMC unanimously decided to hold the key interest rate at 5.25 to 5.5%, citing slower economic activity, and also easing but elevated inflation. That's according to a statement that was issued yesterday. It also removed any reference to future rate hikes. Here's some of what Fed Chair Powell had to say.
It's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it.
All right, and also overnight you saw the US bond yields across the yield curve come off. Of course, that was not related to what the Fed chair said. You had earlier on in the session a regional bank in the US that posted surprisingly weak set of numbers. It posted a loss, and that led to some expectations on Wall Street that the banking sector as a whole is heading for troubled waters. That resulted in a flight to safety, to safe havens, and you saw yields come off very sharply. You saw the 10-year yield fall below 4%. Of course, when Fed Chair Jerome Powell started to speak and pushed back on those rate cut expectations, you saw bond yields rise a bit across the board, but not by very much. In the Asia-Pacific region this morning as well, you've had a bit of a muted start to trade. Of course, the Hang Seng is trading flat at this juncture. The early risers were, two of them, in fact, were trading lower. That continues to be the case. The Nikkei 225 down about 0.8%, and the Chinese markets have opened lower by about 1% or thereabouts. Let's shift attention to the Indian equity markets. Of course, apart from the fact that you have the presentation of the union budget, it is also the weekly expiry for options to take into account. That's also something that we have to take into account. And Agam is here to tell you about the latest cues from that space. Agam, chop and churn, we've seen all through the last week and a half. How do we look at today's session?
We did see advances yesterday, Alex, and that perhaps is a positive because, well, things have changed a little bit, at least in the underlying. So the Nifty did advance by around 1%. Sure, we didn't see any change in open interest, but the Bank Nifty too, which advanced by around 1.5% nearly, which also saw unwinding coming through. So at the moment, over the past couple of days, what we've seen is a lot of traders, well, square off their positions as we moved into the interim budget. Do remember that until before the FM speech, you will have the most amount of traction in terms of expansion in option premiums. And once you start seeing the speech, perhaps you start seeing a little bit of more contraction coming through. Speaking of option premiums, yesterday was a day where the Nifty advanced, and because of that, we saw a little bit more of writing around the put side. But it was also, a choppy day of trade, which is why, we really can't make out in terms of addition or subtraction in options. But we're still working with a 500-point range. And on the higher end, 22,000 is what we are keeping an eye on. Moving on, as far as stocks go, and today's day of trade, we'll be watching out for something like a Pidilite and Pidilite and Cholamandalam, which saw shorts, and longs building in DRL, Maxfin, and of course, several other companies. And in terms of stocks, we saw short covering. We saw Exide, Federal Bank, M&M Financial, PNB, and A Small Finance Bank. Overall, Alex, we are keeping an eye on the benchmarks, of course, and the Nifty. Perhaps it will be a choppy day, and it could in fact lead to increased volatility, considering it is also the weekly options expiry.
Certainly, and in fact the Nifty Bank gained over 1% in trade yesterday. Agam, a couple of financial names are going to be watched very closely today. Of course, HDFC Bank saw a little bit of breather in selling, and it gained in trade yesterday. It gained over 1% and lent quite a bit of support. But in today's trade, you're going to watch out for Paytm, because there was a major announcement by the central bank yesterday. It's announced further restrictions against Paytm Payments Bank because there are updates that they have found from an audit report that have pointed to persistent non-compliance and continued material supervisory concerns. That's from the statement that was issued yesterday. But to tell you what it means, and also to tell you what it means if you're a customer, Vishwanath Nair is joining in to give you some perspective. Vishy, what can you tell us this morning?
Good morning, Alex. So what the RBI essentially did was block any further deposits or credit into Paytm bank accounts, Paytm payment bank accounts from the 29th of February. So remember that customers still have time till the end of this month to make any kind of transactions that they want to do on their Paytm payment bank account. Which are the accounts that are covered in this? Well, any of the Paytm payment bank accounts, if you have a wallet account, if you have any kind of a FASTag account with Paytm payment banks, then all of those accounts are affected by these new strictures that the RBI has brought in. As you mentioned during your introduction, that there were persistent non-compliance issues as well as major supervisory concerns that the RBI found with Paytm payment banks. This dates back to March 2022 when the RBI had stopped Paytm payment bank from onboarding new customers. So over the last 2 odd years, Paytm payment bank has not been bringing up customers onto its business, but the RBI has also found material issues which continue on the Paytm payment bank system. This is after they conducted an audit. What should customers do? Well, they have time till the 29th of February to make further deposits into their payments bank account with Paytm. However, after 29th of February, they will not be able to make further deposits into those accounts. If you have an existing balance in those accounts, then you can continue to use them. You can continue to withdraw that money. Those things have been allowed. But other than that, all other banking services have been stopped by the RBI from the 29th of February. That is till the end of this month.
All right. Thanks so much, Vishy, for bringing us those details. Certainly one to watch out for in trade today. It has, of course, sent out a clarification saying that it's working towards what the RBI has pointed out as concerns. But we'll see how the stock reacts in trade today. We have to slip into a very quick break. But on the other side, we'll bring you a ground report on what to expect from budget 2024. Do stay tuned. Welcome back. You're watching the coverage ahead of Budget 2024. And as we told you, we have a ground report set up for you. Janani, in fact, is reporting live from North Block, where the budget is set to be presented in just a few hours. Janani, if you can hear me, what are you picking up?
Hello, can't hear.
Okay, so let's try and get Janani back with us in just a bit. In the meanwhile, let's turn to a few of the big voices that spoke to your channel ahead of the presentation of the budget. And of course, there are several expectations to take into account. Listen into a few of those big voices.
I continue to think, of course, there's going to be a lot more of what they've already done to carry that forward. So I expect number one, continued investment in defense indigenization, in railways indigenization. So we are going to get a lot more, either the PSUs or the private players, getting a lot more business from the railways in order to improve the mix, which was largely currently buying stuff and then getting services also from companies abroad, which is now changed to buying some stuff from companies abroad, but doing the majority of the work in India. So I think a lot more projects are, and plus you've got a lot of stuff that's still not finished, right? Like so you got a dedicated freight corridor. The DFC still continues to be in progress. So I think that has to be continued and needs budgetary allocation as well. Apart from that, you've got the defense programs, a lot more of the ships that have been ordered, and then their movement towards more indigenization of technology on some of the air equipment as well. I think all of this will continue. So this is like business as usual, but in the sense of this was a process that started about 3 or 4 years ago, and that will continue.
That's quite clear from how the market has been bidding up the railway stocks, the defense related stocks. Infrastructure has done quite well. Banking has lagged because of reduced margins to some extent. But I think banking and the entire financial pack will also be a participant in that. And then auto. As the rural economy picks up steam again, this year, two-wheelers, tractors should see an uptick unless you get another bad monsoon, in which case the government's hands will be full in terms of stimulating rural demand. So those are very clear in the market, and a lot of expectation is there. In fact, there could be a bit of a sell-off if the allocations are lower in railways or defense vis-a-vis what is expected, or the overall capex number will be watched. Last year was a big plus, and I don't expect that kind of a growth, but we could still have growth and not a cut this year. So let's wait and watch. I think within those, what we were talking, we have to look at capital, which is the financials. We have to look at capex, which is all these sectors, the infrastructure providers, construction companies who are putting up roads, bridges, ports, companies, transport, logistics, as well as defense and railways modernization, indigenization play. I think that's a multi-year play that's going on. And finally, consumer. The consumer has suffered because demand both at the lower end of the pyramid in urban sphere as well as the rural demand has not kept pace. So we have a problem with aggregate demand. But in a year where we are expecting rate cuts, with the macro continuing at about an 11 to 12% in nominal terms, we are expecting that there will be money going into these sectors. There will be some redistribution as well as generating surpluses, and that will help.
All right. Now, from an economic standpoint, we also spoke with HSBC's Chief India Economist Pranjal Bhandari about how state capex has been a standout highlight in FY24 and how she expects a fiscal drag in FY25. Listen in.
Actually, the real story of FY24 wasn't central government doing capex. The real story was state governments doing capex. And a lot of people miss that out. State governments which were literally not spending, in the pandemic and the 1 or 2 years after pandemic, suddenly started spending in FY24, and capex spend rose 45% year on year. Very strong numbers. And I think that has been a huge source of growth, particularly construction jobs, particularly rural demand over the last 12 months. So we should always think of capex as center plus state combined. And if you combine the two, my sense is we are at our best in terms of growth rate right now. Next year, the growth may not be as high, but in terms of percent of GDP, the thrust will be maintained. I wanted to make this important point that, there's something called fiscal impulse that economists talk about. That's the impact of fiscal policy on growth. Since FY19, the fiscal impulse has been positive for India. The government has been contributing to GDP growth. FY25 will probably be the first year in which there's going to be a fiscal drag. The government will not be contributing to GDP growth. And that is because it's wanting to bring down its fiscal deficit. And when you bring down your fiscal deficit, you cut spending, and then you don't positively impact GDP growth. So my sense is FY25 will be the first year in many years in which the fiscal policy will take a step back. But I also think it is the right stage for the monetary policy to take a step forward and loosen monetary conditions. I say this not only because fiscal will be taking a step back. I also say this because inflation is really coming off.
All right. Now, one particular sector that has seen tremendous growth over the last year is the real estate pack. And there is a lot of interest in the residential space. We spoke with Irfan Razak of the Prestige Group, and he talked about the potential for giving developers the incentive to make smaller homes in order to make housing more affordable. Listen in.
Important thing is if we can give some incentive to developers to make smaller homes, like in the past we had something called 80IB exemption in the income tax that encouraged developers to make smaller homes and get tax rebates. Similarly, there's one demand, but of course it's nothing to do with this budget. It's on GST. And now see, there used to be an input credit on GST which the developers used to get. And the end product used to be taxed. I believe that the end product today is being taxed at 5%. If that input credit can be restored, it will definitely reduce the cost of the home, and eventually it will, the offering will be much lesser to the consumer. And of course, they can do a balance, do it only for X amount of size of house, and that really will help things, and that will sort of spur up the entire construction for smaller homes, And that's where the actual need is. And I believe if that is addressed, it'll be a big thing for the housing industry and for the home buyers, I mean, for the people who really aspire to have a home. And it will definitely fructify the dream of housing for all, which is our dear Prime Minister's vision and mission. And I think that should get done.
We also spoke with representatives of the Confederation of Indian Industry, and that, of course, ahead of the budget. Sanjeev Puri, the president-designate of the CII, said that the body supports the need for subsidy welfare measures. He spoke with my colleague Tamanna Inamdar. Listen in.
Better targeting will bring in efficiencies, and better instruments of targeting also will bring in efficiencies. I think the government has very, very wisely used the digital infrastructure to actually do direct benefit transfer, for example. So it's more about, sharper targeting and better instruments to provide that support to those who need it. And we completely, CII completely supports this fact that these welfare measures need to happen and need to be strengthened as we go along. But the idea is really to target it more sharply and move more towards direct benefit transfer.
I believe the PLI scheme has been very successful for 3-4 reasons. I think people are, first of all, India has obviously become the cynosure of most companies to look at. One, for its domestic market, and secondly, with this focus on the infrastructure and the cost of doing business, its own competitiveness. Therefore, in that background, I think the PLI scheme is like adding, I would call it the sweetener for people to come in and start investing in India. In that background, that this has been successful. The second issue is that what do we see as action at the ground? And if you look at it, I think there have been, these are all, I would call it, big decisions for people to make, especially considering that they have been integrated into very many global value chains across the world. And therefore, I think it's very difficult to take a decision or take a view from a 1 or 2 year period. So our view is that at least it should actually be extended, and there is a greater opportunity to attract even more investments to come in, not just from overseas companies, but also Indian companies who wish to participate and become part of this global value chains. Therefore, in my view, the scheme has been quite successful. It needs to be further continued, and this will create a large opportunity for both global and Indian companies to invest in India and become part of global value chains.
All right, we promised you this earlier on in the show, a ground report from North Block, and Janani is in fact joining us. Janani, what's the word on the street on North Block? What could we expect today?
Well, anticipation and expectations are quite high despite it being an interim budget. But the word on the street is as simple as this, that firstly, on the subsidies front, the food subsidy could be looking at an increase considering the NFSA Act-led initiative. The PMGKY scheme has been extended for 5 years as announced by the Prime Minister. So that's a certainty on that front that it could see an increased allotment. There's also word that petroleum subsidy would be increased considering that the government has increased 200 rupees per cylinder for Ujjwala beneficiaries, and however fertilizer subsidy might see a bit of a cut considering that global prices are simmering down and it might be a better year. If not a cut, it will be similar to FY24 estimates in FY25. But the next up is also the tax-related incentive, something that we've all been looking at. Now, will the government do something to make the new tax regime sweeter? Currently, individuals who have an income level of up to 7.5 lakhs have a standard deduction option, and up to a 7.5 lakh limit, they don't pay taxes. Whether the government will make this sweeter, perhaps increase the standard deduction, is something we'll be watching out for. Another one, of course, is the concessional tax regime for manufacturing units for corporates who are setting up camp. Now, this was on the back of the COVID-19 pandemic, a scheme that came about. Whether this will in fact be extended, considering that its sunset is now in 2024 March, is something we'll also be looking at. And lastly, of course, some of the schemes that have already been agreed upon, say the PM Suryodaya Yojana. If you remember, this is the one where the Prime Minister had promised 10 million household rooftop solar projects, and this, of course, will require an outlay.
Right.
This is one of the things that we're getting, and last but not the least, the FAME scheme. So there might be also an increased outlay for EV vehicles, is what we're getting to here. Back to you, Alex.
Fantastic. Thanks so much, Janani, for breaking that down for us and setting this up. In fact, there's a lot more to talk about before the Finance Minister takes the stage, and you'll find all of that right here on NDTV Profit, so do stay tuned.